Ec- Excellent. Okay, well, thank you. I'd like to introduce LCNB, or LCNB is the name, right, of the holding company. So
Yes.
almost 2 billion assets, Cincinnati, Dayton, Columbus, Ohio, and now in Northern Kentucky franchise. It's of interest to both growth and income investors. Very good profitability metrics, and an interesting M&A history. So just recently, like within the last few days, your acquisition of CNNB just closed. And many of us here on this conference were CNNB shareholders. So thank you very much for creating the value in the space. We appreciate it. And now we're LCNB shareholders, or perhaps larger LCNB shareholders. So we'd love to get an update on how things look at this point. You know, we all voted on the merger previously, but just to get an update for how things stand now and what your outlook is. So I'd like to, if you could perhaps introduce yourselves, that would be great. I'll turn it over to you. Thank you.
I will do that. So there's 4 of us on this call, and as we go to introduce ourselves, I did try to see if I could share my screen. It said I was disabled to do that. So you guys may need to have to drive that if you want those on there. But my name's Eric Milestrip. I'm President CEO of LCNB National Bank. Been with the bank a little over 35 years. Excited to be here this morning. And then I'll let the other 3, if you could, just give your name and what you guys do, and then I'll come back and start with a few comments. So Rob, I'll let you go next.
I'm Rob Haynes. I'm the Chief Financial Officer. I have been at the bank for a little over 31 years now, and excited to get to talk to everybody today, tell our story.
Matt?
I'm Matt Lair. I'm Chief Lending Officer here at LCNB. I've been around here for 41 years.
And Brad?
Brad Rupert, Chief Investment Officer, been around for about 15 years. Work with these folks kind of in a dual capacity, helping them manage the bank balance sheet and investment portfolio, and then working with our wealth team as well to oversee the overall strategy of investments.
So thank you, guys. I appreciate that. And as you guys said, for all of you out there who are new shareholders of our welcome, and we are very appreciative of that. If you're just a bigger shareholder, we also appreciate that as well. But you're right, it's been an interesting couple of weeks, and more specifically, especially last week, we had the opportunity to do the legal close on CNNB, and everything went well as expected. And now we're leading up to our data conversion, which will be the weekend of December 9th and 10th. So a lot of dialogue going back and forth, mapping, and, we got test week and training weeks coming up, and a number of different areas of the bank. A lot of dialogue back and forth with people. I had the opportunity last week to get back out and visit all the locations again. And so a lot of excitement, a lot of work ahead of us. Going into a busy time of the year, but happy to say that I think we got things under control. And each one of these has its own little life cycle on the whole thing, but we're excited and excited about the team that we have doing it too. So I think the people there at CNNB have been very accommodating to help us through that process. So again, I think it'll be a busy but good experience as we put those systems together, and it gets a lot more fun when that happens, because then you're only dealing with one. Been good so far. We're just excited about being in that area. It's very much part of who we've been and around that area for a long period of time. So we're in Hamilton County a lot more. Obviously, going across the border into Kentucky for the first time, we're excited about that as well. Creates, just in my opinion, a lot of opportunities. We have a decent client base in that area already. And now I think we have some more physical presence to be able to serve them even that much better. Have a number of employees are really excited about not having to drive to work quite as far in terms of getting to some locations to work and being able to take care of customers a little bit easier. I think a lot of opportunity for us, not just from a lending standpoint, not just from a deposit standpoint, where we think there's opportunities there, or with our legal lending limit being much higher than what Cincinnati Federal's was. but especially our wealth area. And, we can talk to that a little bit more here in a minute, but, I think we see a huge opportunity there. And not just because of that area, but also in terms of talking to their employees as they think there's a huge opportunity there too. So, very much excited about, just being in the greater Hamilton area and obviously the greater Cincinnati area when you're talking about being in northern Kentucky now. So real excited about that. In terms of other comments, just quick comments. We've been around for a while. We're for those that don't know us, we're headquartered in Lebanon, Ohio, Warren County. Been around since 1877. We have I guess officially now 34 locations, but go up all the way up to Columbus, Ohio. But Columbus, Chillicothe, Dayton, Cincinnati are the larger MSAs that we serve. We are real fortunate to be in just a variety of good counties that we serve, which has really helped as you've gone through the Great Recession, as you've gone through the pandemic, and you go through the last several months here. That wave of kind of consistency. They don't get too high, they don't get too low, and just in a really good spot with a lot of customers who are still wanting to do projects, which is wonderful. Like everybody else, I think labor markets sometimes it gets pretty tough, but no question that there's also a lot of universities and a lot of different industries around that we could pull from. So it's been very helpful. So, just excited about what our opportunities are. And obviously with CNNB, we had the opportunity to build out a little bit more of, our strategy within, the Hamilton County area and the Northern Kentucky area. And we look very much forward to, really just diving in and deepening relationships in those areas. And like I said, those employees and that leadership of that bank have been very accommodating, and very much a group of people that I think, will be very helpful as we get to meet a number of people. I'll kind of stop right there to see if there's any just general questions at first. If there's, I know there's a few questions that we had kind of going back and forth that we'd be happy to address on. But Julienne, is there anything in particular you want me to start with or go to next?
No, I'm just there, not in particular, but just the acquisition just closed. And so did things mostly go as expected? Was there any unexpected? Okay, so.
No, I think it went, but we were hoping for it to close last Wednesday, and it did. And it was, gotten to get regulatory approval. It happened like it was supposed to, right? A lot of things have to fall in place, and Rob leads our conversion team, and a lot of those things obviously fall in place. Now, there's always little stuff that you're doing all the time, but for the most part, everything that we needed to check off to make sure that it happened, it did. Which was really important because we like having that done and out of the way so we can focus on the data conversion, which is coming next. And that's all on schedule too. So, went fine where we were happy that it went fine, and we were happy that it went as smooth as we thought it would be.
Okay, great. Well, congratulations, because I think it's not that easy of an environment to get it done. So I think that's great that everything went smoothly and as expected, and good luck with the core conversion. So I know, but it's you'll do it great. Can I just ask about the outlook for M&A potential? Kentucky particularly, do you want to get larger there?
When I normally get asked, I go north, south, east, or west, and I normally, kind of answer the question yes, because it's about doing the right deal. We're not afraid to go over border. So whether it's Kentucky or Indiana or whatever, that is not something that we hesitate in terms about doing. So yes, we would like to, have a stronger presence in Kentucky, but you got to start somewhere, and this is our starting point. M&A in general. I guess I'm anticipating that it'll probably come back and be a little more, just a lot more activity. It's been obviously slow, I think, this year, but it's because I think of all that's gone on this year. I think there are a lot of institutions that are probably back to where they were pre-pandemic, in some of their thought processes and what they were doing and how hard it is. And it'll be interesting to see how they react in 2024. I think, 2024 will be a tough year, right? It's going to be something, as you're just looking at the challenges. And my guess is there'll be a little fatigue out there at times, and we'll wait and see. Rob, I hate to put you on the spot here, but any other comments on that when you talk M&A with some of your folks? You're on mute, by the way.
Sorry. No, I think it is, if the right opportunity presented itself for Kentucky, we would be excited to go and expand our footprint into the Bluegrass State for sure. We think there's a lot of opportunity there, and we were excited about the CNB deal because of the opportunity to put our first flag in the ground in Kentucky, for sure. And but we've kind of had our eyes set really on Kentucky for, I don't know, probably the last 4 or 5 years, and trying to kind of learn the landscape a little bit more and get to know that area. So we're making good choices when the opportunities arise.
Okay, good. What about organic build out? Do you have any thoughts about putting up new branches or LPOs or?
Not right now. In that area, we've been pretty public about it, expanding out a little bit more into the Columbus area. We did the Columbus first deal a few years ago, and so we're a little bit more focused on that, and trying to expand some opportunities in the Columbus market. We're in the process of doing a consolidation, building a new office in the Chillicothe market, and then consolidating a couple offices there too, to create some efficiencies, but still serve that customer base in the right way.
Okay, all right. And you mentioned your trust business. It's pretty large. Just the trust assets under management alone, I think, are over 750 million. Is that right? Just for the trust. I know there's other types of assets under management, and it looks to me from the revenues, it throws off almost a 1% revenue on that asset base. Can you just talk about the trust business that you have? What kind of what kind of customers, what kind of assets, and what kind of growth?
Brad, you want that one?
Yep, I can jump in on that. Yeah, so total wealth management assets crossed 1.1 billion this year. You're correct, the 750 million is really in our trust department, and then we have about 350 million in our brokerage division, which is a partnership with LPL. So total about 1.1 billion. Continue to see pretty good growth in that area, and definitely excited about the Cincinnati deal as far as that goes. We already have a pretty good presence down there and have gotten a lot of traction over the last few years from centers of influence down in that market. And we think the Cincinnati deal will really be a big boost to that potentially. We already have a number of our employees, as Eric kind of mentioned earlier, that live down in that area already and have those connections, and they're pretty excited about being able to work a little closer to home. And I think just having that brick and mortar presence will kind of cement some of those relationships that we have with COIs down there. As far as typical customers go, it depends quite a bit. On the brokerage side, tends to be smaller in size. We'll start anywhere with, you come in with $1,000, $5,000. We can find a way to work with you all the way up to $500,000 is kind of their typical client. So that 500,000 and under. There are some brokerage clients that go up to $1 million and above, but most of them are in that 500,000 and under range. And then on the trust side, which is kind of our little bit higher margin area where we do have a little bit higher fee revenue, tends to be the 500,000 and up. Typical client is right around that $1 million range. But as we've kind of grown in the Cincinnati market and kind of enhanced our presence down there with some of the centers of influence, we've really seen larger relationships start to come out of that business. So it's not unusual now to see 10 million and up in some of the relationships that we're getting down that way. So it's been a good growth stretch for us the last several years.
That's good. And about approximately rough number, how does the assets under management break down between equities, fixed income?
Yeah, so on the brokerage side, as you might imagine, that 350 million is tends to be more conservatively invested. There's some annuities and other fixed income products that take up a big chunk of that. So we have been moving more and more towards advisory business, which would be your typical asset allocation type models that are often sort of 60-40, but that's still roughly half of the business, and the other half is a lot of fixed income. So on brokerage, you probably have, you know, between 30 and 50% in equities. And then in the trust business, it's a little bit higher. Certainly, probably if you broke it down, we'd almost be 60-40, you know, as a total mix of assets in trust.
I mean, it seems like you're getting a nice yield.
Yeah, we
Good
do a
deal.
pretty good job of sticking to our fees. You know, when we look at our ratio of fees to overall AUM, we generally, you know, we compare ourselves to peers every year, and we make sure that number looks pretty good.
Right, good. Let's see, we had some questions about your outlook for loans, for loan demand, especially in this interest rate environment that, you know, it's a high interest rate, but maybe starting to level off a bit. Can you talk about how the economy's trending in your footprint and loan demand?
You want me to take that, or you want
You
to?
got that, Matt. Go ahead.
Economy in our area is blessed. I'll just put it that way. Columbus, down through Cincinnati, is a very nice area to be in, and I'm lucky to be the guy that gets the portfolio in that lucky area. The pipeline is about where it was this time last year, which was strong for us. It has slowed a little bit, I would say, when we start having meetings with our officers and sales meetings, but what's in the works right now seems to be about where we were last year. So I'm hopeful that the remainder of this year and next year, guys and gals will start falling in line and finding those deals. But you're correct. People slowed down a little bit when rates went up, and some of the ones that we're closing now are reflective of that. So there's some good borrowers that aren't afraid to do deals still.
And
Okay.
I'll put a plug in for him. He's done a nice job in his team of keeping asset quality really good too. So knock on wood, right? That has held up very nicely.
Yeah, can you talk about how real estate values have been trending for both 1 to 4 family and commercial real estate?
Yeah, now that's a little different scene there on 1 to 4 families. The market's tight, inventory's tight in our entire market. But again, we'll go back to the acquisition. We picked up a nice real estate team down there, which I've just been able to look at the pipeline for a couple days now, but their pipeline seems to be picking up too, now that we're getting some integration work done with them. Positive team. They have good relationships with the realtors that are in the at least Cincinnati area and Warren County area, and I'm hopeful we can grow that team out to the rest of our market.
Okay. And how about on the deposit side? What are you seeing for deposit trends for pricing, particularly in your footprint?
Well, I'll start with that, and then Rob, I'll holler in or add. It's very competitive. We're in an environment and in an area because we are in a good place. There are a lot of people out there competing, and we're not just competing against banks. We have a number of credit unions, a number of large credit unions in our footprint that we compete for. So there's no question that it's difficult. So cost of funds, no question, going up, no question. What happened back in March. We fortunately were, an ICS Cedars customer, so we were able to use those particular products, not just because we're trying to either grow or whatever, but also to protect the uninsured deposits for the few customers that we had that were concerned about that. So just a real big competitive environment, which means, you know, we're relationship driven, which means we got to continue to not only drive our current relationships and make them deeper, but go out and find some other ones. And the better off you do it, you know, it's going to result into, you know, a more deposits, which in the long run is going to help us. So it's fun yet different that we're playing with that side of the balance sheet. You know, for a long time, never had to at our institution. You know, our loan deposit ratio, gosh, for a while was, you know, in the low 70s at one point in time, but you know, over the last several years, it's up to a comfortable spot. But we're also not in a position where, you know, we're 120% lent out. You know, we're still in the low to mid 90s and in terms of loan deposit ratio. So a lot of competitiveness, a lot of talk around our shop about going out and hunting down those. It's just not one person's job. It's all of our jobs. So, you know, I don't see that changing anytime soon. Rob, any other kind of comments?
I would just say that, you know, we have seen some slowing of, you know, rate increases. It looks like hopefully, we're peaking out in the market on some of the rates. I mean, certainly there are those one-off CD specials and whatnot, but from the core deposit pricing, it seems like maybe there's, you know, it's been some slowing down there of the rate increases, at least for now, and hopefully, you know, peaking soon. So that would be good. But I just reiterate what Eric said. It's been our focus. We had those products. We did some of those things. You know, we created some new accounts to get some new money in at, you know, an elevated rate. We had to do that, obviously. But, you know, our big push internally was, you know, doing you know, sales training, getting our core frontline people actively trying to get deposits, really focusing on that, having employees make calls to customers, and really pushing that cultural push of, you know, taking care of what we have and getting more. And I give a lot of credit to our credit lending team. That group really got engaged quickly and were proactive in getting those core deposits from their commercial customers, and if they couldn't get the operating line, getting another piece. And so that was always extremely important. But you know, we have a lot of younger people that have never been in an environment like this. They don't know what this is like to do. And so training those people and helping them, you know, explaining to them that, you know, this has happened before. Some of us older guys here on this call have been around for this before, and kind of leading the way on that has been. So it's been a good opportunity from that standpoint, and getting the kind of the next generation coached up.
Right, very good. Let's see, there's been a couple questions that you answered yourselves, just about the acquisition and the combined bank. And just to sum up what's been on there, it sounds like what was in the merger slide deck largely still stands. You know, that the numbers that you laid out in that slide deck at the time of announcement, you know, are still, you know, good to
yeah, that's true. I mean, there's going to be a true up, obviously, that's going to take place. We couldn't be more in the middle of that true up period, like literally right now, where our fair value group is, you know, we just dumped a lot of data on them in the last 24 to 48 hours, to be quite frank, and they're diving into that. And obviously the rate has not changed a whole lot really since we've announced the Fed slowed down enough. So I'm not anticipating big swings there. But yeah, all the valuations are, like I said, we couldn't be more in the middle of that than we are right now. You know, we just closed 7 days ago. So,
right.
So yeah, so bear with us a little bit on that. There'll be more to come, and we're not too far from the next reporting period, believe it or not. So, well, we're getting through that stuff pretty quickly.
Sure. No, I just, because you had answered to some people, I just wanted to make clear that those are still good numbers to use. So along those lines, you know, in that slide deck, you showed pro forma capital, a very healthy, you know, almost 8% capital ratio, TC to TA. and, you know, with some earnings accretion at, you know, the wind at your back, with the merger and expense saves and whatnot. I believe you have an existing buyback authorization, that's around 2.5% of shares outstanding approximately left. And that's, you know, been on hold, obviously, with the merger. Can you share your thoughts about potentially restarting that, or how you think about capital now?
Yeah, I mean, we like buybacks in general, especially because we feel adamant that our stock price is undervalued, and so we feel like it's you know, it's good for both you know, shareholders who want to remain, and it's good if somebody wants liquidity. So so we feel like both parties, you know, do well with buybacks. I think it makes prudent sense, and it's a good use of capital if there's not another good use. We have, as you alluded to, we've been limited a little bit on you know, we had to play in the fair space and couldn't do too much, and we didn't want to reduce our shareholder base down too much prior to closing on this deal. But we still like buybacks. That's not changed. We feel like, you know, as long as our stock value is below where we feel like it should be, that we'll be active in that space.
Okay, and so what's the timing? What's the earliest you could get back into that?
Realistically, we would probably wait until earnings for the fourth quarter are reported, I would think, at the earliest, just the one to get a nice baseline on where our capital ratios are once the dust settles from, you know, calculating all the fair value accounting, getting all the goodwill set, and those type of things. And then so it would probably be later in the year, but certainly things we'll have discussions with the board as well. And so, I mean, this is our budgeting time of year. We'll be looking at some capital, you know, management policy, dividend, you know, policy, all those type of things will be all set. So well, we like that lever, but it's not the only lever that we use for capital, certainly. And I'm going back to what Eric, I think, started the meeting with is I think we feel pretty adamant that there's going to be there could be some more opportunities for M&A going into 24, and so having capital around to take advantage of those opportunities is always a good thing to have as well.
Okay, and again, that 2.5% authorization, is that like indefinite, or is there a
We can renew it. Yeah, I mean,
okay.
we tend to do it in cycles, but we always kind of want to have it at our disposal. So you never know what can happen with the market and whatnot, and you want to be able to act quickly. So that's a fair way to look at it. Yeah, that it's going to be out there to our use whenever we need it.
Well, you have a very high dividend yield too, or relative. I mean, I think 5.5%,
Yeah.
if I recall. So it's a strong dividend yield. You know, how is that kind of? And now you have some, you know, earnings accretion, like we've been talking about.
Correct.
That's on the come. How do you feel about the dividend? Is there a payout ratio, you know, that you keep in mind or that you target, perhaps, or what are your thoughts?
I mean, we historically we've always wanted to have a strong dividend compared to peer. You know, I think you know, Eric, some of us are at a conference, a banking conference with the Ohio Bankers League, and I think we were in the top 5 in the state in dividend payout, and we're not aspiring to be number 1. I wouldn't say that, but you know, we have looked, you know, about that 40% range. We historically kind of been probably closer to 50. But we have slowly been trying to kind of keep that in that, you know, eke it down to that 40 to 45% range. I think our policy says 40 to 50 still, but you know, we've continued to grow the dividend and raise it slightly. But we've also grown our normal growth our earnings growth has outpaced that you know, increase in the dividend share, but we think it's been appropriate for that. And we'll also have several new shareholders that we'll be paying a dividend to as well.
Oh, we
So,
appreciate your.
yeah. So that you know that'll catch up a little bit now. So
Okay, so no dividend cut, like that's not a issue.
I don't think I would be joining you for the next
Okay.
conference, probably.
Right.
That was, yeah. So we joke about that often. We've many long-term shareholders that would be very upset if we were to cut the dividend.
Right. Very good. And just looking at the deposit franchise one more time, I meant to ask you, there was quite a difference in the deposit costs between your franchise and CNNB's. And so combining it, out of the gate, it's going to be a higher deposit cost, but you indicated you thought you could bring that down over time. I was just curious about what kind of time frame and about how much could you bring it down? Because I know there's some CDs,
There is. I mean, that won't be immediate, but Eric, you probably have a better feel for that than I do. You were more actively involved in the past transactions. I mean, the Columbus First deal there was a much larger disparity between those costs, and so that happened a lot more rapidly because of that. That was completely strategic on our end, and but Eric, I'll let you go ahead and take it from there. From that.
So I think a couple of things. You're right. I mean, they needed to, and I don't think they were as robust in terms of being able to go out and try to get some more core deposits. I think an area where I think we can add some additional services is getting more operating accounts out of businesses, right? Treasury management opportunities, things of that nature. I think, not everybody goes and changes their checking account, whether it's a business or their personal one. They don't wake up on like we heard this week on Saturday morning and say, I'm going to get up and go shop a bank. That's not what they do. So it takes a little bit of time to be able to do that. That being said, I think we'll have a lot more legs on the ground and out there hitting the pavement in terms of going out and getting those kind of opportunities. All of a sudden, a lot of their commercial customers that they have will now have not only another place to be able to have a few more products on the deposit side, we'll be able to help more on the lending side, and that entire relationship should hopefully help the deposit. And then I think as we have some of the items obviously also coming out of our investment, things that are maturing there, I think as we go through 24, we'll be able to, look to see those and they'll reprice, right? They're going to reprice either down paying for higher deposits or borrowings or whatever the case may be, and we'll redeploy those dollars as those come due. And we have a fair amount of that happens, especially in the second half of next year. So I think there's opportunities to do it. From a time frame, it's really tough. If it's up to me, it'd be great if by next Thursday we had 40 more commercial type checking accounts. That's not going to happen because that's not realistic. But I think first steps is let's get them on our system, which is going to happen in December, and then be ready to go looking for those opportunities. And I think Wealth also can and help because they're going to have feet on the ground and they'll be talking about people, and I think they'll be able to bring in some deposits there too. So every situation's a little bit different. It won't go nearly as quickly as we'd all would like to see it, but I think there's opportunities out there.
All right, sounds good. And so just for us CNNB shareholders, I wanted to reiterate that Bob Bettinghouse will be staying there on the board, staying local, I hope.
Yes,
not moving
Bob
Florida.
will, he's scheduled, as we've said, to be added to our board. I believe that'll happen at our regular meeting in the month of November. Bob has done him and really his whole team, but it was very accommodating and very helpful during this whole process. Have a really good relationship with him. Very much looking forward to have him on our board. And then obviously we all have, but I've gotten to get to know him quite a bit over the last several months, and I would say very good. It's been a fun time.
All right, very good. Well, I just noticed the time, so we have to stop. If there's anything else you wanted to, any last comment?
Just thank you. Again, for those of you who are shareholders, whether new or existing and adding, we very much appreciate it. Very much appreciate the dialogue. We thank you for the opportunity just to talk to everybody here. Sorry we couldn't be even more specific, but we're like, as Rob indicated, we're in the middle of it all right now, but thought it was important if we could to stop and be able to talk for the opportunity. Thank you for the opportunity.
Thank you. Thank you, each of you. Take care.
Thank you.
All right. Bye.